Hello everyone, let us continue to learn Chapter 2, Financial Statement and Cash Flow. For this chapter, I will separate 5 sections. So let me introduce the first section is the balance sheet. The balance sheet is the contents snapshot of the firm's accounting value on a particular date. The balance sheet has two sides. On the left side is the assets, and on the right side is the liability and the stockholders' effect. We have put 3 lines equality in the balance equation should indicate. That is not always called by definition. In fact, the stockholders' effect is defined to be the difference between the assets and the liabilities of the firm. In principle, equality is what the stockholders would have remaining after the firm discharged its obligation. So we can look at on the textbook at page 21 on table 2.1. For this table, we can see very clear information, that is the total assets and the total liability and the stockholders' effect. For 2009, the assets is equal total assets is equal total liability and the stockholders' effect, and the 2010 is the same. So we can got this result, that is assets equal liabilities and the stockholders' effect. Okay. Let us continue to learn section 2, the income statement. The income statement ensures for a specific period of time, that means 1 year, maybe 1 month, whatever. The accounting definition of income is revenue minus expense, it is equal income. If the balance sheet is like the snapshot, the income statement is like the video recording of the what the people did between 2 snapshots. The table 2.2 on the textbook give the income statement for the US some calculation for 2010. The income statement usually includes several sections. The operation section reports the firm's revenue and expense from the principal operation. One number of particular importance is earnings before interest and tax, that is EBIT. And another section is the non-operating section of the income statement, include all financing costs such as interest expense. Usually, the second section reports as the separate item the amount of tax levied on income. The last item on the income statement is the bottom line, or net income. Net income is frequently expressed per share of common stock, that is earned per share. Let us to learn the Section 3 taxes. Before we learn the Section 3, I want to introduce some words to easy to understand the Section 3 taxes. First is tax code. Tax code is the result of the political, not economic, not the force. And I still want to introduce another word, average tax rate. Average tax rate is your tax bill divided by your taxable income. In other words, that is the percentage of your income that goes to pay taxes. And another word that is marginal tax rate. This managerial tax rate is the tax you would to pay if you earn $1 more. First, let us learn the corporate tax rate. There have only 4 corporate rates: 15%, 25%, 34%, and 35%, and 38 and 39% because the surcharges applied on the top of the 34 and 35% rate. The taxes is a tax. So there are really 6 kind of corporation tax. Sometimes someone will confuse that what is the average, what is the marginal on the tables. So let me explain like that. If you earn $5,000 for each month, that means you only have to pay the 1/10 of the taxes. That is 15% of your earn. That means you need to pay use 15% of $5,000 times 15%. That's equal how much you need to pay the tax. And someone can make more money. That means about $10,000. So for this taxes, you have to pay $5,000 to pay 15%, and another $5,000 you need to pay 25%, and the marginal tax rate, that is 25%. So the average tax rate, that is 15% at 25%, that is equal 40%, and the average percent is 20%. So so that is easy to separate which one is the marginal tax rate and which one is average tax rate. Well, let us continue to learn the fourth section, net working capital. Net working capital is current assets minus current liability. And net working capital is positive when the current assets are greater than current liability. This means the cash that will become available over the next 12 months will be greater than the cash that must be paid out. In addition to investing in fixed assets, that is, a firm can invest in net working capital. This is called the change in net working capital. Let us learn the last section, financial cash flow. Financial cash flow is one of the most important pieces of information that a financial manager can derive from financial statements. The cash flow is not the same as the working capital. We make that the value of a firm's assets is always equal to the value of the liability and the value of the equity. First, the cash flow from operation. It is that business activity includes sales of goods and services, and it reflects tax payment, that not financing, not capital spending, also not change in net working capital. The other important of cash flow involves change in fixed assets. The net change in fixed assets equal the getting of fixed assets minus sales of assets, fixed assets. The result is the cash flow with the capital spending. We still need to know how to calculate these values. Cash flow paid to creditors and cash flow to stockholders. Cash flow paid to creditors is equal in chase paid minus net new borrowing. That is, use the ending long-term debit minus beginning long-term debit. The same, and cash flow to stockholders equal dividends paid minus net new equity raised. That is the chapter 2. We need to know what is the balance sheet and how to understand balance sheet and income statement, and how to calculate the calculator tax rate, and we still learn some formula, that is capital spending and cash flow paid to creditor, and cash flow to stockholder.